Hey, good morning, it's Owen Bigland and this is the Inside Edge video blog. If you've been listening to the news lately, our Bank Governor Mark Carney and our Finance Minister Jim Flaherty have both expressed concern over Canadians' debt levels. And a lot of this was brought about when Bank of Montreal last week announced a 5-year fixed-term mortgage at 2.99%. Since then, all the other majors have pretty much come match that price or come pretty close to it. Now, what I'm about to say is probably going to surprise some people. Being that I'm a realtor and I make my living selling and marketing homes, I actually agree with our bank governor and our finance minister. I think Canadians' debt levels are pushing up a little bit too high. Now, at 2.99%, this is absolute historic low interest rates. There's only one way for these interest rates to go moving forward, and that's up. I think I read the financial papers every morning. Most people are calling for these interest rates to stay low for the next 12, 18 months. Now, you lock in a 5-year rate, you know you're going to be good for 5 years. After that, though, all bets are off. Now, I can remember I've been in real estate for almost 21 years now. My first mortgage was at about 13.5%. I remember when interest rates slipped below double digits, under 10, I thought I had died and gone to heaven. And it wasn't that long ago that I was renewing mortgages at 7.5 or 8%. So the fact they're down at 2.99, only one way to go. So my advice is, if a bank is going to lend you $500,000, doesn't mean you have to take that $500,000. Maybe you should think about leaving a little bit of money on the table. Instead of looking at that $500,000 property, maybe look at something around 400 or 4.25. Because those interest rates are going to be heading up. And remember, I tried to look on the internet here for a 25-year moving average of Canadian mortgage interest rates. I couldn't find it. If somebody can, maybe they can tweet me or drop me an email. But I'm sure that the 25-year average is probably around 7 or 8%. So that's almost 3 times, or 2.5 times anyways, what the current interest rate is. So that means even if we got back up to the average 10 years down the road, if you're paying $2,500 a month for a mortgage, that's now going to become $5,000 a month. That's quite a bit extra money. So think about it. Maybe leave a little bit of money on the table. I think it's a great idea to take advantage of these record low interest rates, but just don't take all of it. Again, don't be greedy. Maybe buy something a little bit under what the bank tells you can qualify for. I'm Owen Bigland. If you have any questions, you can always reach me at owen@owenbigland.com. Thanks for watching. I'll see you next time.